Well, with the JSE FTSE All-Share Index hovering near record levels, investors may be wondering whether this is an appropriate time to sell local shares, perhaps invest these proceeds overseas. But valuations vary widely, of course, on the domestic market. Now, Jeff Blount, a CEO of Cannon Asset Managers, firstly told us about the analysis he used to evaluate whether the JSE is looking overvalued right now.
Look, one of the things that we like to use in terms of our valuation of businesses, whether they're shares or markets or economies or even sectors, is what we call our cyclically adjusted P. It's a through the cycle price earnings ratio. So what it means is we take the long-term earnings of a business or a sector or a market. We normally take 7 years. We average it, adjust for inflation, and we call that the DNA or the through the cycle earnings. It's actually what the DNA of that entity or market provides in terms of earnings over time. When they look at the price that you pay for that. 1 year P is also a good example to use. They also give you some valuation indication, but you remember your 1 year P takes the current price over last year's earnings, which can be inflated or depressed given some kind of short-term event, strike action or
power shortage.
Power shortage, or even some kind of near-term boom. So the CAPE ratio is a kind of nice DNA type valuation of the market. And over time we find it's very useful. We like price to book, we like Ps, we like a range of them. But we find this one particularly instructive. So what we've done is we've looked at the CAPE ratio for the South African market versus that around the world. Because the question is, people are saying, well, the markets run so hard, is our market expensive? And surprisingly, despite this rally we've had of nearly 40% in the last year and a half, the market is on a CAPE ratio of 16, which is bang on its long-term middle range valuations. So that's an interesting first observation.
Because if you had to look at the PE right now, it's around 19.
It's expensive.
So if you look at the CAPE, it's actually less than that.
Exactly. So based on 1 year valuations, based on last year's earnings, the market is actually is pricey. But based on through the cycle earnings, our market's less pricey. It's just more fair valued. So, but the problem with taking just a market valuation is that it's the tyranny of averages, because your market valuation is made up of subsectors or super sectors in South Africa's case, financials, industrials and resources. And then it starts getting interesting. At the market level, first of all, at a P of 16, a CAPE ratio of 16, it does put our market in the top quarter of expensiveness of markets across the world. So this is developed and emerging markets. So your first gut reaction when you see this number is say, well, 16, relative to our own history, we're near fair value, but relative to other markets, we're actually quite expensive. So you might say, well, then hang on, let's actually look at investing offshore. Let's take some of our equity proceeds and fund offshore equity markets, which are, many of them are very cheap. Europe is a case in point. Some emerging markets actually are interestingly attractive. The one exception to that is the US. The US is on a ratio of 20.
I mean, the US, according to CAPE ratio right now, is more expensive than our markets.
Absolutely.
In fact, if you're looking at it, and you've of course got the South African large cap industrials in there, but third most expensive market in the world. If large industrials were a market in themselves.
You probably, if you're using valuations as a guide to where you want to invest, the US is probably an area to avoid, and you could argue South Africa's an area to avoid. But here's where it gets interesting. If you start looking at the subsector ratios in South Africa, valuation ratios, you start seeing that there's some interesting things happening. Resources are actually very attractive, so the resource sector is incredibly attractive, even in a global context versus other markets. Now we all know why that part of the market's cheap is because we're well versed in the headwinds that the market is facing. But maybe there are some good, interesting opportunity to be picked up there where sentiment's overdone. Financials are attractive in a global context for South Africa versus other markets, and mid and small cap industrial stocks. So sort of your pinnacles and businesses such as that, your mid-tier engineering businesses, they're actually attractive. But the scary part is large cap industrials. Now we all know how wonderfully they've done in the last year and a half. The poster boys for this are Naspers and Richemont and SAB.
British American Tobacco.
BAT, our cash retailers, our healthcare stocks, pharmacare, the drug companies. Lots of areas there have done very well, and people have fallen in love with the sector. But if you take large cap industrials as a sector and you were to characterize this as a market in the world, if this was its own market in the world, it would be the most expensive market in the world. So what you've got is the South African market, mid-range valuations, but expensive versus other markets.
Yeah.
The rest of the market, attractive, but large cap industrials, very expensive.
So what does this mean? I mean, we've got all this information, we can see the graph, we can see relative sector placing right now when it comes to valuations. For large cap industrials, for those who've held on to their Richemonts and been smiling all the way, not yet to the bank, is it time to cash in? Are we going to see a crash in those stocks? I mean, how do you deal with the fact that you're saying this is kind of very worrying at these levels?
Look, understand many of these businesses are expensive because A, they've had good recent earnings growth and the near-term prospects are attractive. Secondly, they're expensive because they're very good quality businesses. They've got great management teams. So in no ways are we, I don't want to start getting hate mail tomorrow, no ways are we saying these businesses are bad businesses.
Yeah.
But ultimately, if you overpay for an investment, you are going to get a poor return going forward. No matter how great that investment at the business level is, if you're paying a very high multiple, you will be disappointed. So I don't think there's this big crash where suddenly these things come tumbling down 40 or 50% and the bell is rung at the top. What I do think you get is a potential that these shares really have to work very, very hard to warrant the current valuations or give you any price appreciation. Now they could do maybe 1 or 2 years you might put it off, but 3, 4, 5, 6 years, and whenever you have this situation, investors find lots of reasons why they can keep delivering. It just takes one earnings disappointment. You're already seeing some earnings rumbles coming out of the pharmaceutical firms. Just one disappointment, even if you grow earnings strongly, but not as strong as the market expected, these shares can take a bit of a knock. That's the risk that you face as an investor.
So when you look at some of these stocks, I mean, if I had to lump Tiger Brands potentially into it, it hasn't been as strong, but it of course has been, a favorite of foreign investors. Talking to Peter McLaren, who is a CEO of Tiger Brands, he was saying that their shareholder base has shifted quite significantly.
Yes,
around 50% of their investors right now, shareholders are foreign investors. They're buying into the African consumer growth story. How much longer do you think that these kind of shares will be propped up by that? And I mean, it's hard to quantify when that kind of big boom in earnings, if it will ever come from Africa, is for the likes of Tiger Brands.
Look, if obviously many of our businesses are attractive globally because they're seen as a springboard into Africa, but other emerging markets, SAB is a classic case in point. I mean, even Richemont, given its emerging market exposure through China, but Tiger Brands, our retailers, our cash retailers. So there's no doubt that these businesses are positioned in very good areas which are growing, and these economies are growing, and the consumers in those areas are going to grow. I suppose the issue is that if the rate of growth has to be high and consistently high. And I think that's where the danger comes, is there's just a little bit of a disappointment. So in Tiger's case, if you're in it for the long haul, I mean, if you're taking a 5 or 10 or 15-year view on these stocks, I think these are great stocks to own. At
this level, though, you're saying,
because you're buying a strategic long-term investment. However, investors are fickle. Foreign investors are fickle, as are local investors. And I think that just as I said, I'm not forecasting any change in the near term, but at these valuations, it's easy for these companies to put a foot wrong.
Yeah.
And if they put a foot wrong, they get punished. Now, the foreigners are even more fickle than the locals. When they don't like the story anymore, they exit. And they don't really care what price they exit. So that's the one lesson. The other observation is made, which is, I suppose, is similar to what you said, is that, most of these businesses, their prices have been driven up, especially the high flyers, by foreign investors. It's not entirely true. In fact, a lot of these businesses have been pushed up by domestic managers, in particular the large asset managers, which have been driving their prices. They're getting lots of cash flows in, lots of people are supporting the large managers, and as a result, they're allocating those cash flows into the domestic market and supporting the stocks they own.
Yeah.
But as I said, so it's just a foot wrong. Our argument goes, if you want to sell South African investments to fund the opportunities you're finding offshore, perhaps these are the areas that you should look at. Rather exit your expensive shares that have done well, and then, I certainly wouldn't be selling resource stocks in South Africa or financials or mid and small cap industrial stocks, to fund overseas
If you want to be
purchases.
taking some money off
Take the money off the table on these stocks.
take it on the most expensive market, if it was a
absolutely.
market, large cap industrial. So let's look across the board there, because I see Greece is still at the bottom of the pile when it comes to valuations on that Cape-based level. You've got the UK, which, looking at it right now from a fundamental perspective, doesn't look that expensive. China even is slightly more expensive than the UK, cheaper than South Africa. So, I mean, where are pockets of opportunity right now if you had to look at emerging versus developed? I mean, what excites you the most? Are there any specific markets that are off the radar even?
Look, I mean, I think that the interesting stuff, I suppose, is if you can get, look, no doubt the future economic action of the world, even if Europe and North America and Japan recover, that's true, they're going to spur on earnings, but the real action over the next 5 and 10 or 15 years is developed markets. That's where you want to have exposure to. So you want companies that have exposure to those markets. It doesn't necessarily mean go and buy Chinese stocks in China, okay, or buy emerging market businesses. What we really like as a theme is actually go and find stocks that are in developed markets that are attractively priced, that have exposure to these global growth drivers, these emerging market drivers. That's the sort of thing you're looking for now. So, for example, Europe for us is actually really interesting, because not only is Europe generally across the board at low valuations, attractive prices, but also versus its history, Europe is very cheap. Many countries in Europe are the cheapest they've actually ever been, okay, using long-term analysis such as this. So they're looking attractive, but now why not go and buy BMW that has exposure into emerging markets, into Asia, into the fast-growing Asian market? That's a great play to make. Even some American investors, while the American market we think is expensive, but Intel's an example. 70% of Intel's revenue is actually generated in Asia. Here I'm buying, I can pay, if you try and find a share that don't judge the share by its domicile, but by where it does business.
And where it generates majority of its revenue earnings.
If the domicile where it's listed happens to be depressed because of domestic factors, Europe's depressed because Europe's struggling with recession.
All the better.
Coming out, all the better. Because the sentiment is pushing those prices down. That's where you find the opportunities.
So I want to get some stock picks from you in the mid-cap, small-cap space, maybe even the small-cap space. Are there any stocks that companies that aren't making the headlines at the moment that are really quality businesses poised for upside?
Again, none of maybe the names I'm going to give you aren't there's no massive earnings surprise next year that they double earnings and suddenly everyone goes, wow. But good, well-run businesses that have earnings growth prospects ahead of them, those are the types of businesses we like. So domestically, I think Sasfin's a nice stock to have a look at. Pinnacle's done very well over the years, but interestingly enough, its earnings keeping pace, keep its valuations at attractive multiples. If you really want to go small, Conduit Capital. If you want to look at Bateman, that's a nice little operation, lots of cash on the balance sheet. So these are decently run businesses that have high return on equities. They've been bypassed because they're not big and liquid, so overlooked. And I think these are the shares that you're going to find opportunities. For the last 5 years in South Africa, large cap shares have outperformed mid and small caps. We know that over time, that's not sustainable. Over time, you want to have a bias in your portfolios to mids and smalls. There's less information in the marketplace about these companies. They're less well researched. They tend to be owner managed. There's advantages there, or management has big stakes in them. There's lots of structural advantages, and because they're small, they have the opportunity to grow. Right now, if you're a big luxury, if you're Richemont, really what you're doing is you're fighting for market share, and all your big companies are trying to fight market share off you. Same for breweries. But if you're a small business that's with growing African footprint, that's a great place to be.